Most investors are playing checkers. They follow the same playbook everyone else follows, read the same headlines, chase the same trends, and wonder why their returns look exactly like everyone else's. Meanwhile, a small group of sophisticated investors is playing chess. They're making moves right now that won't show up in mainstream advice for another 12 to 18 months. They're positioning for 2026 while everyone else is still figuring out 2025. Today, you're getting the playbook. This is the edge. Advanced strategies for people who are done being average. The 2026 positioning framework. Here's what most people miss. The best investment opportunities aren't found in the present. They're found in the gap between what's happening now and what the market hasn't priced in yet. Right now, in December 2025, there are three major shifts happening that most retail investors are completely ignoring. But institutional money, they're already moving. Shift number one, the AI infrastructure build-out. Everyone's talking about AI software. ChatGPT, Claude, Gemini, that's the sexy stuff. But the real money is being made one layer down, the infrastructure that makes AI possible. We're talking about data centers, the physical buildings housing AI compute, power generation. AI needs massive amounts of electricity, cooling systems, keeping those servers from melting, networking equipment, moving data at scale. The play, position in companies building the picks and shovels, not the miners. Think Equinix, data centers, Vertiv, cooling, Arista networks, networking. But here's the advanced move. Don't buy these directly. Use AI to identify the second-order beneficiaries, the companies supplying the companies building the infrastructure. Prompt for ChatGPT. Identify publicly traded companies that supply critical components to data center operators. Focus on companies with 1. Revenue growth above 15% annually. 2. Operating margins above 20%. 3. Market cap between 5 BD 50 buy, sweet spot for growth. 4. Less than 30% institutional ownership, room for discovery. Shift number 2. The reshoring. Wave for 30 years, the trend was offshoring. Move manufacturing to China, cut costs, boost margins. That era is over. Between geopolitical tensions, supply chain fragility, and automation making domestic production viable again, we're seeing a massive reshoring wave. Companies are bringing manufacturing back to North America. The obvious play, industrial rates, manufacturing stocks, logistics companies. The sophisticated play, identify the specific geographies benefiting most. Not all of America. Specific regions with the right combination of available industrial land, skilled labor force, tax incentives, proximity to major markets use, Perplexity Pro to research. Which U.S. metro areas are seeing the highest growth in manufacturing job postings and industrial construction permits in 2025? Then invest in industrial REITs with heavy exposure to those markets. Regional banks serving those areas, they'll finance the growth. Residential REITs in those cities. Workers need housing. Shift number 3, the longevity economy. Here's a stat that should wake you up. By 2030, all baby boomers will be 65 or older. That's 73 million people entering their highest spending healthcare years. But this isn't your grandfather's retirement. This generation has money, they're living longer, and they're not interested in sitting in a nursing home watching Wheel of Fortune. The opportunity, active adult communities, luxury senior housing, home healthcare services, medical devices for aging in place, longevity biotech, companies working on extending health span. The advanced play, use AI to identify companies at the intersection of multiple trends. For example, companies building AI-powered home health monitoring systems. They benefit from aging demographics and the AI boom. The contrarian portfolio strategy, here's where we separate the amateurs from the pros. Everything I just described, that's the setup. Now here's how you actually position for it. The 70-20-10 advanced allocation, forget the traditional 60-40 stocks to bond split. That's for people who want average returns. Here's the sophisticated approach. 60% core positions, the foundation. Index funds for broad market exposure. Dividend aristocrats for income. Investment grade bonds for stability. This is your boring money. It compounds quietly while you sleep. No drama, no excitement, just steady growth. 20%. Thematic positions, the growth engine. This is where you position for the 3 shifts I outlined above. 7% AI infrastructure plays 7%. Reshoring beneficiaries, 6% longevity economy. These are higher conviction, higher risk, higher potential return positions. You're betting on specific trends playing out over 3 to 5 years. 10% asymmetric bets, the moonshots. This is your lose 100% or make 10x money. Small positions in early stage companies via platforms like Republic or Start Engine. Emerging market opportunities. Contrarian plays everyone else is avoiding. The key. Size these positions so that if they go to 0, it doesn't hurt. But if one hits, it moves the needle on your entire portfolio. The AI-powered rebalancing protocol. Here's where most people screw up. They build a great portfolio, then never touch it. Or worse, they tinker with it constantly based on emotions. The sophisticated approach, systematic rebalancing based on data, not feelings. Quarterly review. Protocol: every quarter, run this AI-powered analysis. Performance attribution: upload your portfolio to ChatGPT and ask, which positions contributed most to returns this quarter? Which detracted? What were the primary drivers? 2. Thesis validation. For each thematic position, use Perplexity to research. Has the underlying thesis strengthened or weakened? What new data points support or contradict the original investment case? 3. Correlation analysis. Use Claude to analyze, are my positions becoming more correlated? Am I accidentally concentrated in similar risk factors? 4. Rebalancing triggers. Set automatic rules. If any position grows beyond 15% of portfolio, trim to 12%. If any thematic allocation drifts more than 3% from target, rebalance. If a position drops 30% from purchase price, reassess thesis. Don't automatically sell, but force yourself to re-justify. The tax loss harvesting automation. Here's a strategy that can add 1 to 2% to your annual returns, yet most people never implement it. Systematic tax loss harvesting. The concept: when positions drop, sell them to realize losses for tax purposes, then immediately buy similar, but not identical securities to maintain market exposure. The AI advantage: use ChatGPT to identify tax loss harvesting pairs. Prompt: I own ticker, it's down 15%. Suggest 3 similar securities I could swap into that maintain similar exposure but avoid wash sale rules. Consider sector, market cap, factor exposure, and correlation. Set up monthly scans. Use MakeCom to automate. Pull portfolio data from your brokerage API. Identify positions down more than 10%. Generate swap candidates via AI. Send yourself a notification with actionable recommendations. The options income layer, advanced. If you're comfortable with options, here's a strategy that can generate an extra 3 to 5% annual yield on your core positions. Systematic covered call writing. The setup: identify your core positions you're willing to hold long term. Sell out of the money call options 30 to 45 days out. Target strikes 5 to 10% above current price. Collect premium, rinse, repeat. The AI optimization: use ChatGPT to analyze optimal strike selection. Prompt: I own 100 shares of ticker at X. Current price is POY. Analyze the options chain for 30 to 45 day calls. Recommend optimal strike that balances: 1. Premium income. 2. Probability of assignment. 3. Upside capture if stock rallies. Show expected return scenarios. Warning: this caps your upside. Only do this on positions where you're comfortable with moderate gains in exchange for consistent income. The 2026 watch list. Here are specific areas I'm watching closely heading into 2026. These aren't recommendations, do your own research, but they're on my radar. AI infrastructure. Equinix, EQIX. Data center rate, 5% yield, benefiting from AI compute demand. Vertiv, VRT, cooling and power management for data centers. Arista Networks, ANET, networking equipment for AI clusters. Reshoring, Prologis, PLD. Industrial REIT, with U.S. manufacturing exposure Caterpillar. SIAT, construction equipment for industrial build-out regional banks and manufacturing hubs. Research-specific metros. Longevity economy, Welltower, Well, senior housing rate, 3, 5% yield. Nilanin Intuitive Surgical, ESRG, robotic surgery systems Dexcom, DXCM, continuous glucose monitoring, aging population needs. The execution checklist: don't just read this and do nothing. Here's your action plan for the next 30 days. Week 1. Analysis. Run AI analysis on current portfolio, performance, correlation, thesis validation. Identify positions that no longer fit your strategy. Research the 3 major shifts: AI infrastructure, reshoring, longevity. Week 2. Planning. Build your 70-20 and 10 target allocation. Create watch list of specific securities for each thematic bucket. Set up AI-powered monitoring. Make calm workflows, Notion dashboards. Week 3. Execution. Begin rebalancing toward target allocation. Don't rush. Spread over 2 to 3 months. Implement tax loss harvesting. Where applicable, set up quarterly review calendar. Week 4. Automation. Automate dividend reinvestment. Set up rebalancing triggers. Configure AI monitoring and alerts. The bottom line: the difference between average investors and exceptional ones isn't intelligence, it's positioning. Average investors react to what's happening now. Exceptional investors position for what's coming next. You now have the framework. You know the shifts. You have the tools. All that's left is execution. 2026 is going to separate the people who talk about wealth from the people who build it. Which side are you on? Next week, we're diving into the psychology of wealth, why smart people make dumb money decisions, and how to rewire your brain for financial success. Stay sharp. Wealth is a system, not a guess.